Thank you. Good afternoon, everyone. Today I'm going to share a little bit about the REITs, particularly in the Asia-Pacific market, what has happened recently, and also, most importantly, what is the outlook that we're seeing and the recovery signs that we think the REITs can benefit from. Okay, probably I'll start off by exploring real estate as an investment class. I think in Malaysia, like the rest of the world, real estate probably forms a significant investment class in an individual investment portfolio. The most obvious reason is because of the huge ticket size. And why do people invest in real estate? Serve as a hedge against inflation, and also as a form to appreciation of wealth through the appreciation of the real estate value over time. But even though real estate can provide a very good, decent return over the long term, it does come with its hassle as well when you invest in real estate. So 3 points here. I think the most obvious one, real estate are not liquid. Unlike stocks where you can buy and sell every day, you can't do that with a real estate. Then the second point is, like I mentioned, it's a huge ticket size item, and it involves a lot of upfront costs. And individual investors have to save up for the down payment, and also not forgetting the legal fees that can run up to tens of thousands of ringgit. Then lastly, I think also one of the major headache of investing in a real estate, if let's say the investor rent out the property to collect income, is finding and managing tenants. I think for those who are unlucky, the landlord will have to chase the tenant when they pay the rent rate. In the worst case, the tenant default and doesn't pay at all. So these are some of the benefits and challenges when an investor invests directly in a real estate. So that brings us to a much simpler way of investing in property, which is via real estate investment trusts. In short, that's what we call REITs. What are the benefits of investing in REITs? Firstly, REITs provide a total return to investors, just like you investing in the property itself. While REITs are usually income-oriented, they also provide capital appreciation opportunities as the value of the underlying assets appreciate over time. So just like investing in the real estate. Second point is, REITs also provides diversification, exposure to the real estate market by having this in your investment portfolio, because real estate typically has a low correlation with your normal stocks and bonds, and that helps to lower down the volatility of your investment portfolio. Then third point, it is liquid. It trades just like stocks on regulated stocks exchange, so you don't have to worry about that. You can buy and sell every day. And also, it commands a very low cost of investment. A trade can go as low as a few $100, a few hundred ringgit for trading in REITs. Then lastly, and also I think one of the most important points is REITs are managed by experienced real estate professionals. So these REITs manager, they don't just buy a property for their REITs and then let it sit there, collect rent. They actually manage it actively, and on a regular, ongoing basis, they review the portfolio and carry out asset enhancement initiatives, or recycle the assets that have matured and plow back the money to buy newer assets that can continue to generate additional growth for the REITs. Besides that, REITs also provide access to high-skill quality real estate that individual investors typically doesn't have access to. For example, grade A offices, data centers, as well as mega malls. The very same one that we are sitting in today, Sunway Pyramid, is actually part of the Sunway REIT portfolio, for example. So next, I'll just quickly bring you through what has happened in the Asia-Pac REITs market, and also what is our outlook and the recovery signs that we are seeing. So if I bring you to the chart here, the blue line represents the Asia-Pac REITs index over the last 15 years. So REITs in the 1 decade right up to 2020 has a very stable upward trend, generating about 11% per annum over this period. Then COVID came in 2020 and the REITs market came down, just like the broader stock market. Then when the reopening started happening in 2021, we see a rebound. Then after that, the REITs market went a downtrend in the past 2-3 years, mainly because of one key reason, rising interest rate, as you can see here, represented by the orange line. So as of now, I think we have already passed the peak interest rate cycle. I think last year, finally, the US Fed has started cutting the interest rate back in September. So I think we have passed the peak interest rate cycle, and REITs are well positioned to capture the opportunity here going forward. So moving on to the various markets in Asia-Pac, for the Australian REITs, or we call it A-REITs, they actually were the outperformer in the Asia region last year, and mainly driven by one of single stocks, Goodman Group, one of the largest REIT in this region, driven by the data center growth story. So as the Australian REITs went up last year, you can see the valuations chart over here. In terms of dividend yield, it got compressed. Right now, it sits at about 3.2% for the market, below the long-term average, the lighter green line. So going into next year, what do we think about Australian REITs after their outperformance in the last 2 years? We think the market can still do well, particularly the industrial retail, as well as the alternative segment. We're talking about the childcare, self-storage space. These REIT segments should do well, underpinned by the solid fundamentals. On the flip side, office will probably remain sluggish, given the ample supply in the market. Australia is also a market where the cap rates, the required returns for real estate investment, have repriced faster than the other markets in the region. So as a result, if you see in terms of the asset valuation, the price to NAV measure, it traded quite close to the long-term average, just at -1% discount to the NAV value. So that's quite in line with the historical trend. So moving next to Japan, also one of the key markets in Asia-Pac. Japan was an underperformer last year, mainly due to lack of catalysts, and Bank of Japan, unlike the other central banks in the region, they are actually on a monetary tightening stance. They are hiking their interest rate, unlike the other central banks in this region, where we are starting to see them cutting rates. So that affected the REITs last year. However, despite that, the interest rate in the market is still relatively very low level compared to the other countries. So we see the actual investment activities on real estate that has picked up in Japan especially, and we expect that to remain high going to next year. And this market is a favorite for the foreign investors into the real hard real estate assets. Only one segment that has performed well last year, which is the hospitality. I think quite all of us here would like to travel there because of the weak yen as well. So that should be continued to support the hospitality side going into 2025. For Singapore REITs, they were also dragged last year due to the slowing fundamentals, especially on the logistic and also the hospitality side, as well as those REITs that have overseas assets where they perform weaker than those in Singapore. However, moving to this year, we see some of the REITs actually are seeing a peaking in their interest rate cost, and that should help in terms of their earnings and distributable income. So the few key areas that we like are the retail REITs, data centers. In fact, offices in Singapore is also one of the more resilient compared to other countries in the region. And lastly, on Hong Kong, one of the weaker market in this region affected by the slowdown, both in China and Hong Kong. We have seen the REITs corrected last year, dragged down by the office and retail space. So as a result of that, valuations are actually very attractive right now, as you can see by the dividend chart here, because of as the share price risk corrected, actually dividend yield went up to as high as 8% right now. In terms of the price to NAV value, trading at a huge discount compared to a historical trend. Going forward to next year, we expect the retail side, especially that are those driven by local demand, should remain quite stable. But office probably to remain sluggish given the slowdown in China and Hong Kong itself. Next, I'm going to share with you some of the developments that I've seen in the REITs market. So one of the key things here is in terms of the real estate transaction, the actual property transaction. So that we have seen a pickup lately. You see the chart here in terms of the value of transaction done over the past 5 years. Since the recent peak in 2021, interest rate around the world start hiking up, and we see the numbers and value of transaction done on a downtrend all the way until last year. Only until the fourth quarter of last year, we see some recovery signs here, a very strong pickup across offices, retail, and as well as a big deal done last year, the Air Trunk deal, which I'll talk about more later. So towards the second half of last year, this is one of the major deals done in the Asia-Pac real estate market, where Blackstone, alternative asset manager, they actually acquired Air Trunk, a data center hyperscale operator based in Australia, for a value of 24 billion Australian dollar. This is a very huge deal. Air Trunk itself is one of the largest data center operator in the Asia-Pac region, with a capacity of 800 megawatt committed to customers. It also has a land bank to further increase its capacity by another 1 gigawatt. So another deal that I'd like to share with you all done last year was done by CICT REIT in Singapore. So they acquired a 50% interest in the Iron Orchard Mall, one of the landmark mall on Orchard Road, for a value of 1.85 million Sing dollar. They acquired this from their sponsor group Capital Investment. So this transaction itself translates to a net yield of about 4.9% and is expected to enhance the distributable income for CICT REIT. So these are some of the examples that the transactions activities in the Asia-Pac market are finally picking up. Why? Because they have a clearer picture on the interest rate outlook, where we have seen it peak and now should be coming off. Second thing, I think this has been talked a lot by my fellow peer Christopher in the prior session on the tech. So we have seen a proliferation of data center projects in Asia-Pac region, especially in Malaysia. So here just show the demand for data centers expected to grow exponentially, driven by the cloud service providers as well as more people take up the use of AI technology. So coming to Malaysia, we have seen the strong demand for data centers spill over to our region. So for Klang Valley, Johor Bahru, these are the two key hotspots in Malaysia. You can see the demand just spike up in the last 2 years. I think right now, as of end of last year, the total pipeline of new data center projects in Malaysia comes up to roughly about 4 gigawatts, which is really huge. Why Malaysia? Because Malaysia has ample resources in terms of your electricity and also land bank. So it's sharing a few more samples of the data centers in the Klang Valley and also the few key players. You're talking about global cloud service providers and data centers operators, the likes of Microsoft, your Amazon, and Google. Johor Bahru is also one of the hotspots in Malaysia for data centers new builds. Like I mentioned earlier, AirTrunk is here as well. YTL partnering with NVIDIA, and also the Chinese cloud service provider GDS, your Alibaba and Tencent. So I'd like just to bring you to the key takeaway from the presentation today on our outlook and what is our investment strategy for the REITs market. Three main key points here. When it comes to the interest rate cycle, we have come to the peak, and now going forward, REITs should face easing interest costs, and that should help them to recover in terms of growing their distributable income again. Second point is the green shoots of recovery that we have seen. We talk about the transaction which has start rising. So REITs can take this opportunity to go out to the market, recycle their portfolio, make new acquisitive acquisitions to help grow their income. Then lastly, for our investment strategy, I think it's important for a REIT strategy to diversify across the few sub-segments within the real estate. So the few sub-segments that we like going to next year are your retail, industrial, data centers. But for office space, we are a little bit more cautious and more selective here. If you think the Singapore market is the only one that probably more resilient in terms of the office space. I'd like to share with you our REITs fund, which is called AmAsia Pacific REITs Fund. So this fund has, since inception in 2011, has been able to generate return about 5.9% per annum throughout this period and outperform the benchmark. Bearing in mind the ups and down cycle of the real estate market, including the last 2-3 years where the market corrected. So the fund has still been able to generate a decent return over this long period. Then second point is the fund also has a long track record of paying out income distribution. The fund aims to pay out every year wherever there's distributable income available. Just show here a clearer picture in terms of the fund performance since inception. The red line represents the AmAsia Pacific REITs Fund, and the blue line is the benchmark S&P Pan Asia REITs Index. Below here, you can see the annualized performance over the different periods and calendar years. Next, I'll just show you more about our REITs fund positioning and what's our thoughts on the REITs market. You can see the top 5 holdings that we have here. Goodman, I mentioned earlier, one of the largest REIT and strong data center pipeline that they have. So this is one of the key holdings that we have. Second is Link REIT, is a Hong Kong-based REIT, where we see attractive valuation there. Link REIT itself right now offers about 8% yield, dividend yield for investors. And they cater more to the local demand and not so exposed to the outflow to the China. Over here, Malaysia, we have Pavilion REIT, which is expected to benefit as we go into 2026, we're going to have our Visit Malaysia year. So we expect more tourism promotional activity to take place and start kicking off this year. And that should benefit a destination more like Pavilion REIT. Next, we have Keppel REIT. Keppel REIT is a portfolio of premium grade offices in Singapore, which is one of the sub-segments they are positive on. Then lastly, Fraser Centrepoint Trust, a retail mall that focuses on the suburban areas in Singapore, which is still seeing very strong rental reversion in the past few years. And we expect them to continue doing so going into this year. Okay. I think that probably wraps up my presentation. If you'd like to find out more, do drop by our booth or you can check for more details from our website. Thanks a lot.